Most investors get the buying right. It's the selling that destroys them. When do you sell? When a stock is up 50%, 100%? When do you cut your losses? When you're down 10, 20, 50%? Every individual stock you own requires two correct decisions: when to buy and when to sell. Get either one wrong and you lose. The S&P 500 solved that problem decades ago, and most people still don't understand how. Today, I'm going to show you why I chose the S&P 500 as the foundation for everything I build, over the total stock market, over the Nasdaq 100, over international funds, and why a specific ETF called SPY is the only version that matters once options enter the picture. The S&P 500 is not a stock list, it's a filter. 500 large U.S. companies selected by a committee at S&P Dow Jones Indices. But here's what makes it different from every other index. To get in, a company must be profitable, liquid, U.S.-based, and large enough to matter. Not one lucky quarter, sustained profitability. The kind where your earnings hold up across multiple quarters, not just one good stretch. That alone separates it from most of what's out there. But it doesn't stop once a company gets in. If a company stops meeting the criteria, it gets removed. No loyalty, no emotion, no debate. The index doesn't care about its own history. It only cares about the current state of the economy. That consistent filtering is the engine. You don't need to predict winners. You don't need to predict what sector comes next. You just own the mechanism that adapts to whatever comes next. In 1957, the S&P 500 launched with 425 industrials, 60 utilities, and 15 railroads. Yes, railroads. That was the American economy in 1957. Fast forward to today, technology, healthcare, financials, consumer companies, entire industries that didn't exist in 1957 are now dominant. The names changed completely, the sectors changed completely. But the process didn't. In 1975, the 5 largest companies in America were Exxon, General Motors, IBM, AT&T, and General Electric. Today, it's Microsoft, Apple, Nvidia, Amazon, and Alphabet. None of the 1975 names are in the top 5 anymore. Most aren't even in the top 50. The index didn't need anyone to make that call. It just kept filtering. Here's the part most investors never think about until it's too late. Buying is easy. Everyone loves to buy. You find a company you believe in, you do your research, you make the purchase, you feel smart. Selling is brutal. When do you sell? When it's up 50%, 100%? When do you cut your losses? Down 10, 20, 50%? In aviation, we solve this with procedures. You don't decide in the moment whether to run the engine fire checklist. You just run it. The S&P 500 works the same way. When a company no longer meets the criteria, it gets removed. You never have to decide. The system decides. Let's look at Citigroup and Apple, both in the S&P 500 in 2008. Both are actually still there today. Citigroup crashed during the financial crisis and never recovered to its pre-crisis highs. If you own Citigroup stock individually, you're still underwater almost 2 decades later. Now look at Apple. Apple went the other direction. Same index, 2 wildly different outcomes. If you pick Citigroup, you lost. But if you pick Apple, you won. But you had to pick. That's where the S&P helps you, because it held both and absorbed both the Citigroup hit, rode the Apple wave, and kept going. The index doesn't need every company to win, it just needs the winners to outweigh the losers, and they always have. Now, if you spend any time in investing communities online, you're going to hear a few arguments against the S&P 500. I've heard all of them. Let me walk you through the main ones, and I'll explain why I still landed here. This is the most popular counter-argument, and it comes from smart people. The Boggleheads community is essentially built on this idea. Why own 500 stocks when you can own 3,500? More diversification, more complete coverage of the market. And here's the truth. If you buy VTI, which is the total stock market index, you're going to do just fine. I'm not here to tell you it's a bad investment, but let's look at what you're actually getting. Over the last 10 years, the S&P 500 has slightly outperformed the total stock market. The gap is small, less than 0.5% per year, and the two funds have a correlation of about 0.99, meaning they move almost identically. That's because VTI is already 80 to 85% S&P 500 by weight. The extra 3,000 stocks are small and mid-cap that contribute almost nothing to total returns. Some years they help, some years they drag, but over a full market cycle, it's a rounding error. But here's the part that never gets talked about. The S&P 500 has a profitability filter. A company must show 4 consecutive quarters of positive GAAP earnings to get in. VTI includes everything and everyone. Pre-revenue companies, unprofitable companies, companies actively on their way to zero. The The S&P 500 is a quality screen disguised as an index. VTI is a census of every publicly traded company in America. You want the filter, not the census. And here's the part that should end the debate for most people. Professional fund managers, people who do this full-time with teams of analysts and billions of dollars, they get measured against the S&P 500. That is their benchmark. That's the line they're trying to beat, and over a 15-year period, roughly 85 to 90% of all of them fail. Not because they're stupid, because the index is that hard to beat when it's constantly filtering for the strongest companies in the economy. If the professionals can't consistently outperform it, that tells you something about the foundation you're building on. This is one of my favorites lately. You'll hear a lot about this right now. The top 10 or 7 stocks make up roughly a third of the entire index, so you're not really diversified. You're just making a concentrated tech bet with extra steps. And it's technically true right now. But this has always been true. In the 1980s, oil companies dominated the top of the index. In the late 1990s, it was Cisco, Intel, Microsoft, GE. Then the dot-com bubble popped. Tech's weight dropped. The index adapted. New leaders emerged. That's the mechanism working as designed. Concentration at the top is not a flaw in the index. It's the reflection of where the economic weight sits right now. When that shifts, and it always shifts, the index rebalances itself through price discovery. The concentration you see today is a snapshot. The filtering process is permanent. The textbook answer is that you should own international stocks to diversify. About 60% US, 40% international. And there have been entire decades where international markets outperform the US. That's real. And I'm not going to pretend that it isn't, but over the last 10 years, the S&P 500 has outperformed the total world index by roughly 2.5% per year. And here's the part that most people skip over. S&P 500 companies, they already derive roughly 40% of the revenue from outside the United States. Apple, they sell iPhones in 175 countries. Microsoft, they run cloud infrastructure worldwide. You are getting global exposure through the companies themselves. Adding a separate international fund introduces currency risk, different regulatory environments, and historically lower returns. For the foundation I'm building, that's complexity without a clear benefit. Now, quick hits on the other 3 that I always hear. The Nasdaq 100, it's a sector bet. Over half its weight is technology. It excludes financials entirely. When tech wins, QQQ, they look brilliant. When tech corrects, it falls harder than everything else. That's not the kind of broad foundation I want to build on. That's a concentrated sector bet. The Russell 2000, that's about 3 to 7% of the total U.S. market cap. They're small cap stocks. The premium sounds great in academic papers, but in practice, it's been inconsistent. The volatility is significantly higher and the recoveries take longer. And here's one that a lot of people who watch the news every night, they hear about. The Dow Jones Industrial. It's only 30 stocks. It's price weighted, meaning a stock split changes a company's influence. It covers maybe 20 to 25% of the total market. It's what the news reports every night. It's not what you build a portfolio on. Now, none of these are terrible investments, but none of these are the economy. The S&P 500 is the closest thing you can own to the entire economic engine of the United States. Filter for profitability and deep enough to build on. People call the S&P 500 passive investing, like it just sits there doing nothing. Well, I think we've already figured that out. That's not true. You are passive, but the index is not. The index is constantly screening, removing, replacing, and reweighting. It is making the selling decisions that most investors are too emotional to make themselves. It removed companies during the dot-com crash. It removed companies during the financial crisis. It will remove companies during whatever comes next, and it replaces them with whatever is rising. That's not laziness. That's outsourced discipline. Warren Buffett, the most successful active investor in history, has said repeatedly that if he were advising the average person or even his own wife, the best thing they could do is dollar cost average into a low-cost S&P 500 index fund. Think about that. The guy who built a career picking individual stocks is telling you not to do what he does. He's telling you to own the index because he knows that most people, including most professionals, cannot beat it over time. The S&P 500 is not passive investing. It is rules-based, selling discipline outsourced to a system that does not panic. And for what I'm building, that discipline is the foundation everything else sits on. So if the S&P 500 is the foundation, the next question is, which version? There are several S&P 500 ETFs, VOO from Vanguard, IVV from iShares, SPYM from State Street, which used to be called SPLG, they all track the exact same index. They all charge between 0.02% and 0.03% in fees. For the equity portion of your portfolio, the 80% that sits in straight stock, any of them work. Pick whichever one of your 401k or brokerage offers with the lowest expense ratio. If you're in a 401k that doesn't offer an ETF, well, look for the S&P 500 Index Mutual Fund. Fidelity, they have FXAIX. Schwab, they have SWPPX. Vanguard has its own with VFIAX. They're all the same index with the same exposure with a mutual fund wrapper. They all get the job done. But there's only one thing SPY can do. SPY is the deepest and most liquid S&P 500 options market in the world. It's not even close. The bid-ask spreads are pennies, and the volume is massive at every strike and every expiration date. VOO, IVV, SPYM, they all have options chains, but they're thinner. The spreads are wider, and that matters. When you're trading contracts worth thousands of dollars, a few cents of slippage per share costs you far more than any difference in expense ratios. You might look at SPY's expense ratio of 0.09% and think that's expensive compared to VOO at 0.03%. And if all you're doing is buying and holding forever, well, that's a fair point. Use VOO, use SPYM, use whatever is cheapest in your account. But the moment you want to build anything around the S&P 500, any kind of overlay, any kind of option strategy, and that's exactly what we're going to do in this series, SPY, known as SPY, is your only vehicle. For the 80% equity sleeve, use whatever S&P 500 ETF your account offers with the lowest fee. For options, SPY. That's the whole decision. The S&P 500 is not the most exciting investment in the world. It's not going to double in a year. It's not going to make you feel like a genius at a dinner party. But it solves the three hardest problems in investing. It removes the selling decision, it adapts to whatever the economy becomes next, and it gives you a foundation liquid enough to build real strategies on top of. In the next episode for the Foundational Flight Plan, I'm going to introduce you to options, specifically what they are, how they work, and why they're not as scary as most people think. Once you understand the foundation we built today, you'll see how options become tools instead of risks. Drop a comment. Are you an S&P 500 investor, a total stock market investor, or something else entirely? I want to know where you stand. If this changed how you think about what's actually under the hood of your portfolio, hit the like button. If you want rules-based investing, content without the hype, consider subscribing. Stay disciplined, stay patient, and I'll see you on the next flight.